Good afternoon, Insignio family. Today is Thursday, October 19th, and we are joined with Brett Collins from Nomura Corporate Research and Asset Management, joining us from Boston. How are you, Brett?
Doing well, thank you, Alejandro. Really appreciate the invitation. I'm looking forward to an interesting discussion today.
Our pleasure. And by way of a little introduction here, we usually have our CIO, Ahmed Riesco, doing the calls, but our fearless leader is out on the field working on one of the acquisitions that we're working on. So today, I have the pleasure of doing the PM speaker series with Brett, and we're going to kick it off here with kind of framing the topic. You guys are involved in multiple sectors within the fixed income market, and you've got teams all over the world. Can you elaborate a little bit more on that strength?
Sure. So, I work with Nomura Corporate Research and Asset Management, which is a high-yield boutique, but we're part of the Nomura Asset Management family. Right, so Nomura Asset Management has, covers the gamut in terms of asset classes, has investment professionals located in Asia and Europe and in the U.S. And the group that I work with, Nomura Corporate Research and Asset Management, or as we call ourselves, NCRAM, is a credit manager. We're a credit boutique, and we specialize in high-yield bonds. We manage U.S. high yield as our flagship. We also manage European high yield. We manage global high yield strategies and emerging markets, corporates, and sovereigns. All right. So, NCRAM as an asset manager, there's three things that really make us unique, right? So we manage about $30 billion total. So we're a good-sized boutique. But the first key differentiator for our organization is our experience. We've been managing high yield for more than 30 years, right? So we're one of the pioneers in the asset class. And our flagship U.S. high yield strategy has outperformed its benchmark by 265 basis points annualized over that 3-decade period. Second differentiator that makes us unique is the experience of our team. The four key leaders, senior leaders of our high yield organization, have worked together for more than 2 decades. They've managed portfolios across multiple market cycles. So they've learned the right strategies and tactics to employ in different types of market conditions. And that's one of the key differentiators, one of the key drivers of our performance. And then third differentiator is our organizational structure, right? So I mentioned we're a boutique with full investment autonomy, quite a bit of operational autonomy, but at the same time, we are part of this $500 billion investment management organization at Nomura, right? So we can leverage the benefits and strengths of a top 50 global asset manager. And that allows us to really focus on investing and developing investment solutions that meet the needs of our clients.
Great. When we were speaking earlier on in the week, you mentioned a unique investment philosophy that was predicated on the strong horse theory. You want to elaborate a little bit more for us?
Yes. So this is something that all of our strategies, all of our credit strategies at NCRAM are underpinned by what we call our strong horse investment philosophy. And this is actually a very important part of our corporate culture. We have a snapshot, we have a painting on our wall that's a picture of a horse pulling a cart. And it's so important for our culture because it's a metaphor for what we're trying to accomplish as investors. So if you think of the image of a strong horse pulling a heavy cart, those are the kinds of companies that we're looking for in the high yield universe. So we're not looking for, flashy ideas. We're not looking for new companies with no revenue. We're looking for companies that have the proven capability to pull their debt load across the economic cycle, right? So if we're successful in finding these strong horse companies and avoiding the weak horses, then our clients will benefit from the yield and the carry that associated with bonds issued by these strong horse companies. But as the strong horses kick off additional cash flow, we'll be able to delever their balance sheet. So the risk premium required to hold those companies' bonds will decline, triggering capital gains, right? So the strong horse philosophy really allows us to generate value through both income and capital gains in our high yield portfolios.
Okay. Sticking with the high yield topic before we go into some of the other sectors, kind of on the technical side, could you give us some color on what is different today as far as issuance in the high yield market, and just the on the fundamental on the technical side? We've seen that there's less companies that are considered high yield right now, for better or for worse. Is that already kind of priced in the market? And just given less issuance, is that troublesome for a high yield investor?
No, it actually, I mean, there's well over 1,000 issuers active in the high yield space, right? So we have no shortage of investment opportunities. But the high yield market has changed in the last decade. First and foremost, the high yield market is a much higher credit quality market than we've seen historically, right? So about 50% of the high yield market today is rated BB, right? So high yield issuers are rated BB, single B, triple C, and below, right? Historically, we have never seen 50% of the market rated BB. Today, just shy of 50% of the market is rated BB, and that's because last decade, when oil prices were low, there was a significant number of downgrades in the energy space from investment grade to high yield. And then during the pandemic, there was another substantial wave of downgrades. So formerly investment grade companies have fallen into the high yield universe. And at the same time, on the triple C side, usually a signal that we're reaching a market top is when we start to see heavy issuance in the triple C market. That issuance tends to happen late cycle. We did not see that in this cycle for a number of reasons. First of all, there's very little M&A. Interest rates are high, so merger and acquisitions are more expensive, so we're not seeing much M&A activity. Secondly, this is really the first cycle where we've seen a significant private credit market. So the private equity firms that like to pay themselves dividends by tapping the bond market aren't doing that in the public high yield market. They're doing that in the private credit market, where they get faster execution. They have great relationships with private credit companies. So they're not tapping the high yield market with those triple C issues. And then finally, again, one of the hallmarks of a market top has been triple C deals getting done, weak credits with poor covenants, low protection from covenants. Those deals haven't happened in the high yield market this time. They're happening in the loan market. Right? The loan market is trending towards lower credit quality because triple C issuers are getting better execution in the loan market due to appetite for loans from collateralized loan obligation deals. Right, so the loan market is trending in the direction of more lower quality companies. 70% of the loan market is triple C or below, single B or below. High yield market, 50% of the market is single B or below. And so those deals, those low quality deals aren't getting done in the high yield market. So the triple C market today is about 10%, which is historically low. Double Bs are about 50%, which is historically high. So it's a higher credit quality market. When we're looking at spreads, spreads in the high yield market are sort of right in the middle of the range we've seen over the last 10 years. They're not excessively cheap, but they are cheap when you think about this is a much higher credit quality market than it's been in the past, right? So, we think the yields are attractive, not as concerned about the spreads.
Sure.
And sorry, Alejandro, but you asked about technicals, right? So there's been very light issuance in the high yield market, right? In 2020, 2021, we saw more than $400 billion of issuance per year. Last year, about 110 billion. This year, about 140 billion so far. So, very light issuance. That lack of supply very much helps the supply-demand dynamic in the high yield market.
Interesting. Let's go over your outlook for the economy.
Sure. So, our base case assumption is that the U.S. will lapse into a mild recession. And we think this is well priced into the market because, as we engage with clients and certainly as we, observe the actions and talk to other asset managers, it seems to be a very uniform consensus that the U.S. will lapse into a mild recession. That may or may not prove to be right, but we think that that's priced into the high yield market today, that expectation of a mild recession, right? So we're not on our own on that perspective. But we've had a lot of internal deliberation. Are we too conservative, right? Are we too pessimistic about the economy by assuming a mild recession? Should we be focused more on a soft landing? And, we've stayed in that mild recession camp because of the tightening that's already taken place, right? So there's a lot of positive factors in the economy today. The employment market, very strong. There's 9 million job openings in the US versus 6 million unemployed workers, right? So that's a very positive signal. There's a lot of pockets of growth around the US, areas like energy, travel and leisure, infrastructure development, employment and investment opportunities. But at the same time, there's been a significant amount of tightening activity impacting the US economy. Right? The Fed has tightened by 525 basis points in less than 2 years. Money supply has been negative year over year, every month this year. We haven't seen that since the Great Depression. If you look at like the Senior Loan Officers Survey, if you look at the Dallas Fed Credit Survey, credit conditions are incrementally tightening quarter over quarter in the US. Right? These are all factors that work as a braking force on the economy, and they have long and variable lags. Right? So eventually, this tightening activity is going to impact economic growth. And then when you add on high oil prices, when you add on much higher borrowing costs, when you add on the geopolitical challenges we're seeing in Ukraine and Israel, these are all forces that are going to act to slow the economy. So we expect a mild recession to begin in the first half of 2024.
And we really haven't seen anything, quote unquote, break yet. You can argue, March we had a little taste of something breaking, but it's going to take a little while for the Fed's policy to kind of take hold. And so that being said, what is your outlook for rates?
Yeah. So, it's funny that probably the biggest thing that is broken is the treasury market, right? There's been, rates are up 75 basis points or so this year, right? That's a pretty substantial move in the treasury market. If you look at some of the seasoned issues out there, longer term treasuries trading at a steep discount to par, right? That's a substantial move. And it's well founded, right? That, Fed rates are much higher. So short-term borrowing costs are higher. And the US government is spending like we're in the middle of a hard recession. And we're not. We're in a growth period with very low unemployment. So they don't really have much flexibility to ramp up spending if the economy slows. So it's kind of an unsustainable situation that's leading to much more supply, which is driving rates up. And, I haven't really seen any hard data on this, but I think some of the emerging markets economies are, very keen to move away from a dollar-based economy so they can trade in their local currencies, right? So I think we're seeing some selling from countries like China that are using this as an opportunity to help sort of break the confidence in this dollar-based global economy and move towards more of a local currency-based economy. Right, so I think they're viewing this crisis as an opportunity, right, to consider continue driving confidence down in the U.S. Treasury market. But that said, the interest rates have been spiking. Treasury rates have been spiking. When the Israel situation started to unfold, a week and a half ago, we saw a fast flight to quality rally. Treasury rates decline. So what we were watching earlier this week was, as rates started to increase again, was it going to break through 480, which was the sort of pre-Israel height? It blew through that pretty easily. And then we looked, was it going to break 488, which was the intraday high before the Israel situation? It blew through that this week. So, the next resistance point is probably 5.2% on the U.S. 10-year, which was the peak of the 10-year treasury rate before the global financial crisis last decade. Right, so that's probably the next resistance point. It's not clear that we're going to get there, but we think there is some more short-term risk for rates. But in the longer term, as the economy slows, we do expect rates to come down. And one of the factors that we watch pretty closely is PCE inflation, personal consumption expenditures, which, as the Fed has made clear, is their preferred measure of inflation. So if you think the 1 month number is too noisy, the 1 year number is too lengthy, So we've been looking at rolling 3-month annualized core PCE inflation. As of the latest reading, that's at 2.3%. So that's getting closer to the Fed's 2% target. Right? So as the economy slows, then that will probably accelerate the downturn in inflation to get down towards that Fed's 2% target. In that case, the Fed's hands are uncuffed. They'll be more flexible, more ready to cut rates if needed. If the economy does slow, unemployment starts to increase. That our expectation for Fed rate cuts starting in the middle or the second half of next year, probably going to drive Treasury rates down across the curve. So we're a little bit cautious on Treasuries in the near term, but looking out over 12 months, we think rates are going to be potentially substantially lower than they are today.
It's an interesting point that you bring up. It just seems like the marginal buyer of a U.S. Treasury, and marginal could be maybe not the right word because China is not a marginal buyer, but it seems that from just looking at the price action that, some of these buyers are less enthusiastic to come into the market, and that's troublesome.
Yes, and even friends like Japan, right? The Japanese, as they're getting closer to ending yield curve control, Japanese yields are becoming more interesting, right? So that's another source of demand that potentially could dry up. So before the global financial crisis, and back in the Clinton days, there was the concept of bond market vigilantes, and Clinton's his political advisor James Carville said that he wanted to die and be reincarnated as the bond market because it was so powerful. And that the days of the bond market vigilante looked like they were behind us, but that's probably going to come back. And we saw it happen in the UK last year when the UK the new government announced kind of an unrealistic budget, and we saw a spike in treasury rates in the UK. I think the U.S. is at risk of the same thing. If we don't get spending under control, if we don't adopt more sensible and sustainable economic policies, then the bond market will act as vigilantes and force the government's hand.
In investing, the 4 most expensive words is "this time is different." So. But it certainly is food for thought as you're watching the price action and just seeing who is stepping in that was there before and is not there now. So given that you guys have a multi-sector approach within fixed income, you guys could be in high yield, you can be in investment grade, you can play in treasury markets. Where are you seeing the best value, and what have been some of the best performance drivers?
Yeah, so when we we travel around the world and we meet with clients, with wealth managers, we meet with institutional investors, with pension funds and government agencies. There's a lot of clients around the world that are happily sitting in cash, right? Earning 5% on money markets, earning 5.5% on T-bills. But at the same time, acknowledging that there is going to be a time when they want to lock in that duration, they want to lock in attractive rates. So the two questions is, what's the right timing? And when I do move, does it make more sense to go into high yield or investment grade? Right. So we are very much in the camp that high yield makes more sense than investment grade. And one key reason is that if you're moving out of, say you're holding a 6-month T-bill at 5.5%, and you move into investment grade, yielding a little better than 6%, you're really picking up a little more than 50 basis points of yield while adding substantial credit risk. If you're considering moving out of a 5.5 T-bill into high yield, you're eyeing an asset class that yields more than 9%. And so you're picking up more than 350 basis points of yield. And I think that's one of the key drivers and one of the reasons why high yield has outperformed investment grade this year. And then, looking at the prospectively high yield versus investment grade, the high yield, again, yields more than 9% with duration that's less than 4 years. But if we compare that to investment grade is yielding a little better than 6% with 6.5 years of duration. Right? So if the market moves sideways, you're better off in high yield because the carry's better. If interest rates continue to increase, if treasury rates continue to increase across the curve, you're better off in high yield than investment grade because of the shorter duration. Sure. If there is a soft landing, which is a distinct possibility, then at 430 basis points of spread, there's room for 75 basis points of tightening in the high yield market. That's worth 3 points of return. So high yield is likely to outperform investment grade in a soft landing. The scenario when investment grade would outperform high yield is, again, that much harder than expected recession, an environment where treasury rates decline and spreads widen. Then you'd clearly rather be in investment grade. But again, we think that's a low probability outcome just because of the strength in the economy and resiliency of the employment market that we're seeing.
Sure.
Now, within high yield, sorry.
No, continue.
I was just going to say, within high yield, our flagship product is the U.S. high yield. We also manage European high yield. We manage emerging markets. Right. So when we look at U.S. versus Europe, Europe is pretty interesting right now. Europe is a higher credit quality market. 67% of the market is double B rated, less than 5% triple C, so higher quality than the U.S. And 3 years of duration versus 4 years of duration in the U.S. So from a valuation perspective, Europe normally trades inside of the U.S. on spread. Now it's 50 basis points wide. So it's interesting. When you look at the high yield, if you look at the yield on European high yield hedged into dollars, it out yields the U.S. But it trades cheap for a reason, right? The economic prospects in the U.S. are better than in Europe, and Europe is more prone to suffering from a recession. But the biggest problem is they haven't solved their energy problem. They solved it for the short term. Last year was a warm winter. You can't depend on a warm winter every year. Their energy tanks are topped up. Their natural gas tanks are topped up, ready for the winter. But they haven't solved the sort of long-term energy sourcing if they're not going to be importing energy from Russia. So industry is moving out of Europe into places like the U.S. where energy is more abundant and prices are more stable and more predictable. And I think that's a long-term drag on Europe. So we favor U.S. over Europe. And then emerging markets, particularly emerging markets corporates, we think is a very interesting market. Right, 60% is investment grade versus 40% high yield. You're only giving up less than 100 basis points of spread to buy emerging market corporate versus high yield. Across rating buckets, emerging markets is less leverage, so you get higher credit quality companies at the same point in ratings with more spread per unit of leverage. So from a valuation perspective, from a quality perspective, it's very interesting. But our concern about emerging markets is really the geopolitical risks. Right, so you're paying for those geopolitical risks, but if there is a deterioration in Ukraine, if there's a deterioration in the situation in the Middle East, that's going to hit emerging markets more substantially than it will hit U.S. high yield. So again, it's cheap relative to high yield, but we think it's cheap for a reason. So the U.S. high yield we think is the most interesting asset class in our universe right now.
Great. As we talk about defaults and the default cycle, I mean, we're kind of at a low level today. How do you see this playing out, and who's most exposed for the pain?
Yeah, so there's a lot. I think a lot of macro players who don't really understand the issuers within high yield, don't understand the dynamic of the high yield. Look at what happens during a recession and what happens to defaults. And the answer is default rates, increase pretty substantially. More than 5% default rate during a recession. But what they're missing is the underlying credit quality of the market. We just talked about that. This is the first time in history that we've had yields close, or a percentage of the high yield market that's rated double B around 50%. Right. Again, historically low levels of triple C's, which are the most prone to default. So we just don't see a spike in defaults because of the credit quality of the market. At the same time, the fundamentals are deteriorating in high yield. They're not as strong as they were 6 and 9 months ago, but they're slowing from a very high level. The leverage in the high yield market is 3.5 times, and that's the lowest we've seen in more than a decade. Again, a little bit higher than it was a few months ago, but still very low relative to history. Interest coverage is probably the best predictor of defaults. Interest coverage, before a couple of months ago, was never above 5 times in 30 years of data. Interest coverage today is down a little bit from that, five times interest coverage that we saw a few months ago, but it's at 4.8 times. So it's still very strong. So, given the resilient fundamentals in high yield and the credit quality of the market, we're expecting an increase in defaults. Last year, the default rate was less than 1%. That's historically low. Right now, it's 1.3% over the last 12 months. We expect a small increase in defaults, maybe up to 2.5%, 3%. The long-term average default rate in high yield is 3.2%. We think this cycle will end with a default rate that's below the long-term average.
Great. Family, if there's any questions from the field, please, you can send questions over. We've got a question here regarding consensus views, and if there's any kind of out of consensus kind of thoughts that you would like to share with us.
Yeah, so look, I think the consensus view, and the thing that probably makes me a little bit nervous, is the fact that there's so much agreement that the most likely outcome from the US is a mild recession. Again, I think if there's an outcome that's different from the consensus, it's probably going to be a soft landing and not a hard recession. Within the high yield market, probably the most impactful driver of our strong performance this year has been our overweight to travel and leisure, particularly in cruise lines. That's an area that, when we look at the weightings of our competitors' portfolios, travel and leisure has been a much lighter exposure. So our exposure to cruise lines, gyms, gaming, hotels has been a little bit non-consensus, and we've had overweight in that space. And that has been a very important contributor for our performance this year.
Wonderful. Okay, and in conclusion, last thoughts here that you'd like to leave us with.
Yeah, so look, with my colleagues and I have had the pleasure of engaging with the Insignio team on several occasions this year. We're really impressed with the work that you've all done in building your business, and we have we're very, very eager to continue collaborating with you. We think high yield is going to be an interesting market for your clients to look at. There's a lot of cash on the sidelines. So, we think that it makes sense to lock in duration. We expected decline in rates coming, towards the middle of next year. So, it makes sense to get in front of that move. I think it makes sense to move into high yield, but also love to discuss our European and emerging market corporate funds with you as well. So, we look forward to a solid end to 2023 and a very exciting 2024.
Indeed. Well, ladies and gentlemen, that concludes our PM speaker series for today. Brett Collins with Nomura, thank you so much. We appreciate your time and your partnership.
Likewise. Thank you, Alejandro, and thanks all of you for joining.
It was great. Thank you.
Insignio Financial Group, LLC comprises a number of operating businesses engaged in the offering of brokerage and advisory products and services in various jurisdictions, principally in Latin America. Brokerage products and services are offered through Insignio International Financial Services, LLC, headquartered in Puerto Rico, and through Insignio Securities, LLC, headquartered in Miami. Both are members of the Financial Industry Regulatory Authority, FINRA, and Securities Investors Protection Corporation, SIPC. Investment advisory products and services are offered through Insignio Advisory Services, LLC, an investment advisor registered with the Securities and Exchange Commission. In Uruguay, advisory services are offered through Insignio International Asesores de Inversión Uruguay, SA, Insignio Asesores de Inversión Latam, SRL, and Insignio Asesores de Inversión de Uruguay, SRL, in Argentina, and through Insignio Argentina, SAU, and in Chile through Insignio Asesorías Financieras, SPA. Collectively, these 8 operating businesses make up the Insignio Financial Group. To learn more about the broker-dealers, including their conflicts of interest and compensation practices, please go to https://insignio.com /disclosures/ or via www.finra.org. To learn about Insignia Advisory Services and any conflicts related to its advisory services, please see its Form ADV and brochure, which can be found at Investment Public Advisor Public Disclosures website, https://advisorinfo.sec.gov/.